also confirmed that she's being used as a political.
Right, good afternoon, YouTube. Joining us on the 4th of August, Thursday, one of the busiest days of the week normally. And we've had plenty to get our teeth into today, as we tend to find on a Thursday. So today, you will have heard that the Bank of England have raised their interest rate as expected by a 50 basis points, seeing that priced in about 92% before the market received the number. And that's exactly what we got. So let's have a look at how the market reacted to that. Often with interest rate hikes, you might anticipate that higher interest rates would yield a higher currency strength. However, this was also accompanied by some pretty bleak news about the economy. Bailey was, in his statement, was forecasting that we are likely to go into a recession in the UK in the fourth quarter. And that recession will last for 5 quarters. So that takes us the whole way through 2023. This is the first time we've seen a rate hike this strong for 27 years. We are also expecting a hike, or it's reasonable to expect a 50 basis point hike in September, was the terminology that was used. So we're seeing particularly, that's on the Fed FOMC expecting 50 basis points. Yeah, the Bank of England have still been pretty aggressive. We've seen this sort of dovish move, these kind of dovish hikes, in a way, when we see the economy sort of, if you have a look at the FTSE, for example, we've actually seen this react pretty well to the number. And this is what we kind of saw. This is when the number was released at 12, a nice little push higher initially. And that is indeed, albeit we're starting to see a little bit of weakness come through. But if you have a flick back to what we saw with the pound, we saw some pretty strong selling across the board. There was a pretty bleak view going forward. Inflation up north of 13% by October. This is obviously all leading into the cost of living crisis, which we are all very conscious of. Bailey went on to say that he feels that this will inevitably hit those on lower incomes more than those on the higher incomes, but even felt that those in the medium income bracket would still very much be feeling the pinch of these, first of all, higher rates, which obviously have an impact on borrowing. And with the UK being a very large, or a large proportion of the UK wealth is all in property compared to their counterparts, say, for example, in the US, that homeowners, working class, middle class people were really going to feel the pinch as we move through on this. So where do we go from here? So we've kind of run the stops on the lows here. We are still kind of struggling to get too much back on the pound. I mean, bear in mind, this was, the pound had done pretty well before the number. We had a little kind of rally higher. And this is something we see a lot, this little sort of liquidity grab. When you're getting interest rate decisions announced by major central banks, you often see very few orders in the order book. And you can often see the market move in the wrong direction first and then flick back the other way. And indeed, that's what we saw here on the pound today against the dollar. Cable had a little spike up, grabbing the liquidity at this level. Anyone with stops in above the highs, anyone trying to preempt this trade, even if they thought that we were seeing it lower, may have had stops at this level. And indeed, we kind of popped through the highs of yesterday, which would have been another level at which liquidity would have been grabbed. So pretty textbook liquidity grab, something we see a lot of in low volume markets, which the summer always is. So not unusual price actions, but just be conscious of this if you are trading data around summer or around Christmas, around US holidays, that you may well see these sort of liquidity grabs quite frequently. The bigger the data, the more likely you are to see them. If you remember back to the CPIs last month, we had that little ramp up, not after the data, in the 8 seconds prior to the data, we had about a 30 tick rally on the S&Ps, which is quite an incredible move, just due to no volume really being in the market. So it's got ramped up that number. And with the inflation data out next week, so that's on the 10th, the CPI data in the US, I'd be careful with that sort of thing around that data point too, because that's going to be one of the bigger numbers that we get going forward, given that the Fed have now made it very clear that they will be data dependent. But Bailey at the Bank of England echoed those thoughts. He is going to be looking very much at inflation rates going forward, see whether they can possibly ease off on their interest rate hikes. But his comments today, as we were watching him, he looked pretty glum out there. I wouldn't expect there to be too much positive sentiment with regards to inflation in the near term. It feels like it is very much embedded, and getting it down from where we are near the 9-10% across the board in the Western world, getting that down to 2% is a long way off. Maybe getting it down to 4, 5, 6% might be fairly easy, but keeping it, getting it from that 5 down to 2 might take an awful lot more work. And traditionally, with interest rates and with inflation, you need to get the front end of the curve to get the rate to get above the CPI rate in order to quell long-term inflation problems. And if you're looking at that currently, you'd be needing to stick interest rates up at that above that 10%, or by October above 13%, which the UK housing market simply could not handle. So I think the strategy for Bailey is to try and ramp this up a little bit, create a bit of demand destruction, get these rates down into next year to see if we can settle things a little bit. If we get the rates down to that 4 or 5%, maybe we'll start to see those rates creep up to that level in order to put this to bed. But this is a long way off. There's a lot of water to go under the bridge between now and then. So that is something to keep an eye on as we go forward. Before we get to the open, want to talk to you about the DAX. We had a nice little gap here. We mentioned this literally, on the 12th of June, that we had this nice little gap on the DAX. And finally, after the weekend from the 10th to the 13th, we managed to get ourselves this gap closed. This always, you think, does happen in markets, tends to happen quite a lot in larger markets. And as soon as we got to that gap close level, lo and behold, that is the top of the DAX today. And we're already off at 100 ticks on the DAX since tagging that level. So that was something we were mentioning in the group earlier this morning as well. If you do want to join us, one of the other things we had on today was doing live Zooms during the Bank of England rate announcement, and kind of dissecting the core of what was said, and the votes, which were 8-1 in favour of a 50 basis point hike, and the implications, therefore, on the currency and the indices going forward. And if you like the content that we're putting out, and you would like to be part of the ad hoc content we do around interest rate decisions and inflation metrics, then details are in the description below. So, pretty good technical gap close there on the DAX. Moving over to oil. This is a market that has been very good on the opens of late. Oil market on the NYMEX opens at 2 o'clock. Yesterday, we had some pretty strong selling straight out of the gate. Just to kind of put the sort of size of this into perspective, you really wouldn't need too big a stop to survive anything on the open there. And by the close, we were down about $4.50 on the oil market. Similarly, a little bit of weakness coming out here on this chart isn't complete. I didn't see that gap myself on my broker, but when the market opened at 2 today, we've already seen over $1 off in the first 28 minutes of trade. So another nice clean move again, with very little in the way of upside risk when you're entering right on the open. Picking a direction is obviously another thing, but if you can just trade the momentum and put stops beyond, the oil market has done this maybe 2 out of the 5 times a week, and you can really monetize these sort of trades. It's a very, very hot market at the moment, to excuse the pun. As we get forward to the equity markets, we are seeing the Dow really starting to struggle today. That's the one that's really been walloped in the past 15 minutes or so. S&P is also nudging lower. NASDAQ also having a little look. And we're seeing this across the board in Europe as well. Starting to see the DAX, as I say, off that 100 ticks from the high there, and getting down towards the value area low for the day. And even the FTSE, after an initial rally on that news, is coming off. Just on a note of this on the FTSE, for those of you who aren't aware, the FTSE has a lot of banking components, and higher interest rates are actually very good for the banking sector. When interest rates are at 0, it's very difficult for them to have large margins. Whereas when interest rates creep up higher and higher, it's quite easy for them to sneak in another like 10, 20 basis points on their margins. And that can make a hell of a lot of difference to a bank. If they are mortgage providers, they can squeeze a little bit more out of their money. And that is why often the FTSE is one of the better markets to react to interest rate hikes. And to be fair, one of the reasons why, if you look at the FTSE this year versus its counterparts, look at this on a daily chart, for example, the FTSE from the start of the year is not too far from its highs. I mean, we were at the start of the year trading around, where would be, if I can bring this up a little bit. And for the start of the year, we were trading pretty much where we are now. And if you have a look at the Euro stocks, we are way off those levels. Similarly on DAX, S&Ps, NASDAQ, Dow. The FTSE has been a stalwart and tends to be when inflation pressures are on, because interest rates are tending to respond well. Also helps that the oil crisis with a lot of oil producers and on the FTSE can, no doubt, aid to profits in those balance sheets. And that's something that I'm sure the Conservative government are going to have a look at with those windfall tax. But as we approach we're into the open now. Initial bit of weakness on the Nasdaq. Some of that weakness being bought back on the Dow. As we always say, these first couple of minutes of trade can be pretty choppy, so always be careful with this. You can easily get wicked out, especially on things like the Dow, which tend to have a little bit less volume going through them than the likes of the S&P, which is a much truer market, in my opinion. A lot more volume goes through there, and in order for this market to move through key levels, it needs a lot of more buyers or sellers than the Dow would. So I would always, if you are new to trading and you don't like the real hot volatility, then rather than look at the Dow and even Nasdaq, I would maybe stick to looking at the S&Ps just for that little bit more simplicity with the trades that you're looking at. For the government bond yields, 10-year yields down here on the right-hand side, these are starting to nudge up. There does tend to be an inverse correlation between the yields and stocks, so this may give us a little tell on where that stock market may go today. But this is, when we look through the day, there's not too much more to get our teeth into. We've got Fed member Mester speaking again at 5 o'clock. If we scroll back to Tuesday this week, he was speaking at 6 o'clock on Tuesday. Where are we? That takes us through to the 2nd of August at around 6 o'clock. And he was helpful in bringing us down quite a few ticks on the Dow here. Where are we? Best part of 200 ticks in a little over an hour. So just be aware that the whole Fed mantra at the moment is to try and get hawkish. They were quite dovish last week at the meeting, which they tend to be, try and push markets up. And when the big man Powell is on the pulpit, but when reality bites and markets are actually responding very well to this, they do get a bit concerned, and then they come out on the wires and start to talk about no rate cuts in 2023, whereas the market is very much pricing some easing in as we approach kind of mid to late part of next year, that we will start to see some of those rates come back down a little bit. Be interesting to hear what Mester says today. There's not too much more out than that. If you're trading natural gas, be aware the storage numbers are out at 330. That moved the oil market quite a lot yesterday as well, so just be conscious of that. And then tomorrow is always a big one. Non-farm payroll figures, not an easy figure to trade. And always, when inflationary times, have a look at the average hourly earnings. This is a decent part of component of wages, and wages are a decent component of the core CPI number as well as the headline CPI number. And the Fed really want the core CPI down a couple of times before they even consider taking their foot off this brake on the economy. So maybe the average hourly earnings, as we've been saying all year, might be more interesting to trade than even the jobs. With the good news is bad news situation, given that the Fed is so, as of last Wednesday, going to be much more data dependent, we will likely see a inverse reaction to this. So if jobs data is strong, that's going to suggest that inflation may continue to push higher, which in turn will mean interest rates will have to go up, and indices do not like that. So if you are trading non-farm payroll and you're used to seeing this number come in higher and rally in stock markets, kind of follow on from that. Just be cautious that since last Wednesday night, now they're not using forward guidance, they're now using data dependence for their rate hikes. Then perhaps this may be worth looking elsewhere. The likes of the currency market or gold may be a little bit simpler to trade, or you can try and capture on the other side if you wish. It's pretty, as I say early to say, you want to see maybe 2 or 3 or 4 pieces of data come through either above or below forecasts, just to check that is exactly the responses that we're getting from we had the GDP figures last week come in negative, and the markets did fly that day. But then on the PMIs yesterday, we had some decent numbers, and the market rallied anyway. So who knows? Maybe it's just buy stocks. That tends to be a winner over the past 15 years, albeit not too much this year. We go back to the markets, have a little look at where we're at. Weakness on the S&Ps. Dow is definitely leading the way on the downside. Where are we? We're off 2%, 0.2% on the Dow. S&P unchanged from yesterday, and Nasdaq up a smidge. So pretty mixed again so far in the trade. Take it easy. The market has been a little bit easier to trade, I'd say, after the European close this week. So if you have the ability to show a bit of patience, you might get something a little bit easier to get your teeth into from 4:30, 5 p.m. onwards. But good luck out there. We'll be back in the morning with you on Zoom. And thanks for listening. Speak to you again on YouTube on Tuesday.